Amidst the historic downturn in China's property market, some banks and cities like Nanning, Hangzhou, Ningbo, and Beijing have taken drastic measures to combat the depressed market conditions. They are now allowing individuals to extend their mortgage repayment terms until they reach the age of 95, effectively enabling 70 years old to secure loans with maturities ranging from 10 to 25 years. This move comes as the property market slump continues, with new home prices declining for 16 consecutive months until December, and major developers experiencing a significant drop in sales compared to previous years. Last year, the Chinese government's effort to curb debt finance property and its strict zero COVID policy had a considerable impact on the economy, resulting in a modest 3% in gross domestic product. These policies were aimed at reducing China's reliance on debt and controlling the spread of COVID 19, but their combined effect had significant consequences on economic expansion. The question stands now, what aimed to China's property market collapse? Hi everybody. China's property market is falling largely due to government's crackdown on debt finance property, a policy that aimed to break China's addiction to debt. Let's first understand on to how does the impact of property market downturn affect the global and local government. The impact of property market downturn can have a significant ramifications for local government. Number 1, reduced revenue. Local governments heavily depend on revenue from properly related transactions such as land sales, property taxes, and development fees. During a downturn, the demand for property decreases, leveling to drop in land sales and property transactions. This reduction in revenue can create budgetary shortfalls for local government, making it challenging for them to fund public services and infrastructure projects. Number 2, strained finances. With decreased revenue from property transactions, local government may face financial difficulties in managing their day-to-day operations and fulfilling their financial obligation. They might find it harder to repay debt incurred for previous infrastructure projects and may face challenges in borrowing new funds. Number 3, impact on local GDP. The property sector is closely linked to economic growth, especially in regions where real estate is a significant driver of the economic activity. A property market downturn can lead to a slowdown in construction, reduce consumer spending, and decrease economic activity in related industry, thereby affecting the local gross domestic product. Number 4, employment and livelihood concerns. The real estate sector is a major employer, with construction, real estate agencies, and related industries providing job to a significant portion of the population. A downturn in the property market can result in layoff and reduced job opportunities in these sectors, affecting the livelihoods of many residents. Number 5, housing market stability. Local governments are responsible for ensuring housing market stability and addressing issues like housing affordability and availability. A property market downturn may exacerbate existing housing problems, making it harder for local authorities to provide suitable housing options for their residents. Number 6, social unrest. And number 7, impact on local businesses. Last year, the Chinese government's effort to curb debt finance property and its strict zero COVID policy had a considerable impact on the economy, resulting in the modest 3% growth in gross domestic product. These policies were aimed at reducing China's reliance on debt and controlling the spread of COVID 19, but their combined effect had significant consequences on economic conviction. Moving further, when the government cracks down on debt finance property, it aims to curb excessive borrowing and speculative behavior in the real estate sector, particularly among developers and home buyers. The goal is to address financial risk, promote financial stability, and reduce the overall level of debt in the economy. Here are some potential outcomes and effect of such a crackdown. Number 1, reduce speculative buying. One of the main objectives of the crackdown is to discourage speculative buying in the property market. Speculative behavior, where investors buy property with the intention of quickly reselling it at a higher price, can lead to a housing bubbles and volatile price movement. By limiting access to easy credit for property purchases, the government aims to dampen speculative activity and promote a more stable market. Number 2, slower property price growth. Number 3, financial risk mitigation. Excessive debt in the property sector can pose systematic risk to the financial system. A crackdown on debt finance property aims to mitigate this risk and prevent potential financial crisis that could arise from the property market bubble post. Number 4, impact on developers. Number 5, impact on home buyers. Number 6, slowdown in construction. Number 7, impact on local governments. And number 8, economic growth moderation. The property sector plays a significant role in China's economy. The slowdown in the property market have a ripple effect on the related industries, employment and overall economic activity. Thus, China is facing a debt bomb at home. Lastly, before concluding, let's understand what can be the potential measures that government can adopt to resolve a property market downturn and its associated challenges effectively. To resolve a property market downturn and its associated challenges, governments can consider implementing various measures. The specific actions taken will depend on the unique circumstances and causes of the downturn, but here are some common approaches that can be adopted. Number 1, monetary policy adjustments. The central bank can use monetary policy tools such as interest rate adjustments to influence borrowing cost and credit availability in the economy. Lowering interest rates can make borrowing more affordable, stimulating demand for property and encouraging investment. Number 2, fiscal stimulus. The government can introduce fiscal measures like tax incentives and subsidies to boost demand in the property market. For example, offering tax breaks for the first-time home buyers or reducing property transaction taxes can spur activity in the sector. Number 3, relaxing loan restrictions. To ease credit constraint, the government may consider relaxing loan to value ratios or down payment requirements for the home buyers. This can make it easier for people to access mortgage financing and increase demand for property. Number 4, infrastructure development. Number 5, debt relief for developers. In case where property developers are heavily burdened with debt, providing targeted debt relief or refinancing options can help stabilize the sector and prevent widespread default. Number 7, property tax reforms. Number 8, encouraging rental market. Number 9, supporting first-time home buyers. Number 10, transparent real estate data. Number 11, regulatory flexibility. The government can adopt a more flexible and adapting regulatory approach to respond to the market condition. And number 12, targeted regional policies. Addressing regional disparities by implementing targeted policies for specific regions with unique challenges can help stabilize the property market more effectively. It's important to note that any measures taken to resolve a property market downturn should be carefully designed and balanced to avoid creating new imbalances or exaggerating existing issues. Additionally, the effectiveness of these measures can vary based on the overall economic conditions and the root causes of the property market downturn. Policymakers need to assess the situation comprehensively and adopt a mix of measures suited to the specific circumstances of their economy and property market. Hope you liked the video. Let's unlock your full potential and achieve remarkable success in the world of business. If you are new to the channel, do like, share and subscribe for more such content related to business and finance. Till then, goodbye everyone.